Coming up in today's video, gold prices are hitting fresh all-time highs, and silver is also hitting 14+ year highs as well. Meanwhile, the S&P 500 is little changed here this morning at the time of recording this, and Fed's Bostic sees no further rate cuts this year. Taking a quick look at the US dollar, you can see we are tapping into resistance here, and so far on this Monday trading session, we have seen a little bit of softness in the dollar following the 3-day upward move that we did see following the FOMC meeting last week. And as we see gold touching a fresh all-time high, naturally we are seeing many people call this overbought, overstretched. It's got to pull back. And while I do think personally that it is looking a little bit stretched, that does not mean that gold prices have to reverse from here. And I wanted to show you guys a little something that I found looking back at history when we had these kinds of moves in gold. Check this out. So I've pulled up a monthly chart here for the price of gold, and I wanted to go back in time and take a look at some historical instances where we had major bull markets in gold, starting with this one that I found here in the 1970s. Around August 1976, we did see gold prices bottom out before going on a massive run to the upside. It topped out at a 758% gain in about 1,250 days, which is an incredible move and a massive return on the price of gold. It went from $100 an ounce, which is hard to believe in today's world, to all the way up to 873. Now, of course, afterwards, it did have a multitude of years where it went down and traded sideways and didn't do a whole lot. You could see it was actually a prolonged bear market for gold following that. But then in 2000, we bottomed out and we had another massive run up in the price of gold. And going from the lows here to the highs of this move that we saw between 1999 and 2000, gold prices made a 658% return in the following 4,350 days. Let's now take a look at today's move and ask ourselves, are we nearing some similar sort of returns as we are seeing a pretty monumental breakout here on gold prices? Well, let's take a look at the percentage gains from this low here that we put in 2022. Perhaps we could take this as our starting point, or we could take this one, but I'll show you it doesn't really matter because what we find here is actually gold prices, even with the massive run up that we've had, are up 131%. Very far from that 650 or 750% return that we saw in past decades where we saw massive moves in gold prices. But what about if we took the bottom in the end of 2015 all the way till now? Well, you can see that one's got a 254% return. Again, still a long shot if we were to see some sort of similar gain in the price of gold of 600, 700%. And so is this move stretched? Sure. In the short run, it does look like it's had, an exhaustive move to the upside. But to try and call the top is a very difficult game. And what I find is you're more likely, in my opinion, to continue to see gold prices rise in coming years than fall. Of course, anything can happen, but I think history is a good thing to go off of. And so in my opinion, is gold price short term a little stretched? Sure. But I wouldn't short it, and I'd be more interested in buying it than not if we were to get a pullback after this run up. Like if we were to see a move back down to, let's call it 35.30, or even better, a prior retest of this breakout point around 34.40, that could be a really interesting buying the dip opportunity in my personal opinion, as I do still think there's plenty of room for metals to move higher. Another very interesting thing in markets right now is actually the gold mining companies. GDX is an ETF that tracks a collection of gold mining companies. And you can see this thing is massively up here in recent months, actually outperforming the price of gold substantially. This is a 43% move since July. And if we were to scroll back here from that beginning of the year, I mean, this thing is up 120%, which is pretty crazy. Here's GDXJ, which is junior miners, so smaller, kind of more speculative investments, but you can see this one's up 122%. And we can also look at Global X Silver Miners ETF, SIL, and you can see this one is going parabolic here as well, up 100% in just a few months. So there's a lot of speculation around metals as to whether or not this is overbought or not. In my opinion, the path of least resistance is for higher prices, but if I'm going to build a good risk management plan around it, I'd wait for pullbacks personally. By the way, a quick nod to why I think gold miners especially look so attractive is you still have low oil prices. And of course, mining is a very fuel intensive process. And so low fuel prices do bode well for mining companies. Keep an eye on this if you're a gold miners sort of bull yourself. What's interesting is despite the Fed cutting rates, we do still see yields moving higher. perhaps the bond market kind of rejecting the idea of lower interest rates, with concerns still mounting high of inflation remaining sticky. Here's a look at the consumer price index, which has been trending up in recent months, 2.9% being the latest consumer price index reading. And we still have, for multiple years now, not been able to reach our target inflation rate. In fact, we've bottomed out and started to turn around here to the upside now. But it seems like for now, the greater concern of the Federal Reserve is actually the labor market, which is prompting them to cut interest rates. We can see that we have actually started to see a little bit of an uptrend in unemployment rate forming here as jobs out there seem harder and harder to get. Take a look across the economy. We have the non-farm payroll, where hiring has been very slow. We've not seen a huge surge in new jobs being created. Instead, what we have seen is not a lot of hiring, not a lot of firing, and just sort of a stagnant jobs market, similar to the housing market actually. One green flag last week was actually the unemployment claims number, which jumped the prior week and came down in the latest week, which was good, right? Less people filing unemployment, less people filing unemployment is of course a good thing for the jobs market. So we'll keep an eye on this for the latest numbers. Today's video is sponsored by BlackBull Markets. BlackBull is a New Zealand FMA regulated broker offering Forex, metals, and crypto trading to their users. With access to over 26,000 tradable instruments, everything from gold, commodities, indices, and more, through their CFD platform, you can trade pretty much anything. They're also backed by one of New Zealand's largest investment management firms and provide institutional grade trading conditions. BlackBull Markets has also earned multiple industry awards for their fast execution speeds and their leverage trading opportunities on their platforms. Traders can access up to 1 to 500 leverage and choose from several platforms like MT4, MT5, CTrader, and TradingView. And something super cool is that they offer no commission on crypto trading, as well as highly competitive spreads, especially on Ethereum. And for a limited time, active traders can receive free TradingView Premium and up to $60 reimbursed every month just for trading with BlackBull. And if you're interested in copy trading, they have an expansive platform just for that. You can see real trading results from other traders in a live environment through their copy trading platform. And when it comes to choosing a great brokerage, choosing one with competitive trading costs in the form of spreads and commissions is very, very important. With their ECN Prime option, you can see spreads from 0.1 pips, which is pretty crazy. And of course, if you're a larger trader, this institutional package looks incredibly competitive, with spreads from 0 pips as well as a $4 round turn commission. Of course, there is a minimum deposit on this, but all three of these look highly competitive compared to the industry. Make sure to use the link in the description down below. We'll leave all the information you need to start trading with BlackBull and start taking your trading to the next level with their amazing platform, their competitive spreads, as well as their copy trading platform if that's something that you're interested in as well. So like I said, make sure to use the link in the description down below to support my channel and also to check out BlackBull to see if it's a right fit for you. Now back to the video. But let's string it all together and take a look at kind of the overview here of this market and the economies, especially here in the US. I've pulled up the US economic heat map, and what we have here is we have some not great jobs numbers, right? We had slow NFP numbers, we had slow ADP numbers, we had slow job openings here in the US. But we also have some spots of positives, right? We have retail sales numbers, which came in strong, consumer still spending, GDP growth actually above expectations of 3%, we got 3.3%. By the way, we do get some fresh data points on this week, and services PMIs actually showing some optimism going forward about the services component of our economy. That's a good thing. So this leaves me with a bit of a neutral bias on the US dollar and sort of a neutral to almost positive on stocks, though I still think stocks at all-time highs have room to pull back a little bit. By the way, if you want to try out the EdgeFinder, it is now available for free on our website. We have a limited version, I should clarify. The whole thing is still a paid product, as we have to pay all the money to build and support this product. But if you want to try out the free variation, it is available now on our website, and I'll leave a link in the description down below if you want to sign up for the free demo version. Many traders that watch my channel want to implement some level of macro fundamental analysis into their trading, and having a tool like this can truly really help to spot those opportunities and to automate the process a little bit, because fundamental analysis is sort of this up in the air thing where you have all these data points to track and consider, but having a software tool to actually generate a summary report out of these data points can really take things to the next level. And going one further, we also have the top setups algorithm, which essentially takes a look at a huge collection of data points and generates bullish and bearish biases for many many different currency pairs, commodities, indices, etc. It's looking at economic data like GDP, PMIs, retail sales, CPI, PPI, PCE, employment data, and interest rates to gauge what things might be stronger or weaker. The top setup simple page makes it even easier. It kind of conglomerates everything into, or it consolidates everything into these simple categories: technical reads, sentiment reads, and economic data reads. So if we look at like USD CHF, this is getting a bullish reading, or USD CAD. I want to take a look at both of these currency pairs quickly to see if there's any setups. The dollar versus the Canadian dollar to me actually looks interesting. If you get a move up and over this 1.3850, this could be a pullback opportunity in my opinion to see further upside in the dollar CAD. And the dollar Swiss franc technically does not look very good to me, but if you were to see some sort of larger scale reversal, perhaps there's some opportunity to buy that dip, which again has been a big dip. You've seen really the Swiss franc quite strong against the dollar here this year. You can actually see when we take out minor currency pairs, we have a very thin watch list currently here on the EdgeFinder. The Nikkei is getting a bullish reading. I wanted to take a look at that. Here's a look at the Japanese stock market, sort of the same story that the US stock market has, which is I would be an interested buyer, but not at these levels. So I'd be looking for a pullback, perhaps a continuation of this upward trend that we have seen in 2025. So I'll watch for a pullback on this one. Specifically, I like this pullback here to this trend line and prior level of resistance turned potential support. This is an all-time high right here. So a little bit of a pullback from there to me could be a possible buy the dip. The chart looks really good, and I like it overall. We're actually getting a pretty soft score for the Japanese yen when we look at the Japanese economic heat map, which is a feature within the EdgeFinder. What we can see here is that CPI is actually at 2.7%, which came in last week. 2.7% inflation is lower than its previous number at 3.1%, which could act to soften the Japanese yen a little bit here, and a softer yen is usually good for the Nikkei. Here's a look at dollar yen, still choppy and range-bound market here. If you're looking for bullish setups, again, I would be looking for a break. And if you're looking for bearish setups, be looking for a break to the other side, but still very much in consolidation on this pair. And I've selected now for minor currency pairs. A couple things start to pop up. The Australian dollar versus the Japanese yen, the pound dollar versus the British pound versus the Japanese yen, and the Swiss franc versus the Japanese yen. Let's take a look. Taking a look at the Australian dollar versus the Japanese yen, we are actually getting a bit of a pullback here that looks pretty interesting. If we were to get a pullback to the 38.2% retracement, in combination with this retest of support, this actually looks like a very bullish setup in my personal opinion, and I'll see if I can catch a trade there. And just a reminder, if you want to get access to the trades that I'm taking when I take them, consider joining our VIP group. There's a link in the description down below, and you can sign up to get notifications of every trade that I take with entries, exits, etc. I trade commodities like gold, silver, I trade FX, I trade indices, stocks and options, and much, much more. We also have Marco's trades if you're familiar with Marco from the live stream. We also have Chris Pulver in here and Ivan as well. We have an active trading chat room, coaching webinars, and much, much more. So if you're not already in the group and interested in joining, there'll be a link and discount promo code in the description down below for you to explore, or you can send us a direct message on our website if you have any questions and would like to speak to someone on our support team about getting access. And long duration debt or long-term treasury yields across the world are still remaining high. Take a look at the Japanese government bond 10-year yield, still on the rise here. Here is a look at the UK, which has really not come down, even though we also see like the EU, for example, they've been cutting interest rates, and yet we still see the European 10-year government bond yields remaining high. Why is this? Typically, the short end will start to move down when the central bank cuts rates, but the long-term government bond yield, like for example, the 20-year yield in the US, doesn't necessarily have to follow the short end. The short end is dictated largely by what the Federal Reserve or the respective central bank does in that economy. But the long-term interest rates are set by the global financial markets themselves. As again, long-term debt is essentially bought and sold as a tradable asset, right? When you go and get a mortgage on your house, that 30-year mortgage is something, of course, that is set by the market rate. And so even though the Fed may be cutting interest rates on the short end, there's still this concern that, national debts are very high. We have huge national debt to debt GDP ratios across the world. And so when you look at that, you say, well, the bond market is saying, if we're lending money to governments, we better get a good yield because there's a lot of risk to lending to governments that are spending frivolously, and inflation could remain an elevated factor. So there is still not a ton of demand for government bonds, and the demand that there is demanding higher yields. Now, all of that combination acts to bolster, I think, the price of gold. There is a international worry about government spending, not just in the US, but in many places. Government spending being very high and out of control is really something that makes people fearful, and they instead elect to invest in something like precious metals or hard assets to get away from the fiat currency system. And it may sound like I'm elitist for cryptocurrency here, but before there was crypto, the gold people were saying the same thing. This concept of protect your wealth by getting outside of the dollar universe or the yen universe or the euro universe, the pound universe. All of these currencies are created by people. People are flawed, governments are flawed, and there is massive national debts all around the world that I think investors are worried about. And that's where I think gold can continue. I do not think gold has to have some sort of massive reversal or crash. And in my opinion, dips in gold prices and silver prices are buy the dip opportunities. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.